What's up everybody, I am Jaspreet Singh and I've been listening to the Federal Reserve Bank's latest meetings and you can start to hear that they're getting a little bit worried, not just because inflation is still around or because Jeff Bezos is criticizing the government's response on inflation, but because they're not sure how they're really going to bring inflation down. Not to mention the fact that stagflation, which was the worst case scenario previously, is becoming a much realer possibility. Stagflation is a weird economic concept where on one hand you have a slowing economy and on the second hand you have growing inflation, which means prices of things are going up while wages are going down. Not a good combination, and the last time that we saw this happen in our economy was back in the 1970s. Now, to be completely clear, the Federal Reserve Bank still says that they're not worried about stagflation, and the expert economists also say that they don't think that we're going to be entering any sort of stagflation, but you should also remember that those are the same people that said that inflation wasn't a problem. They said that inflation was transitory and that it would just be completely gone by the end of 2021. Now, at this point, you might be wondering, but Jaspreet, how do we know that the Fed is actually getting nervous and how do we know that they're worried? Well, I dug a little bit deeper, and if you start to listen to what the Fed is actually saying, you can start to see that they're starting to scramble with their solutions on how they're going to solve the problem, because one of the things that they're proposing now across the board is hiring freezes to help solve inflation. Now that might sound kind of odd. How would hiring freezes help solve inflation? I mean, if you have these sort of hiring freezes, that's going to hurt the economy because that means companies are hiring less people. Why would the Fed want companies to hire less people? Well, it goes into this inflationary cycle because what's been happening is you have companies that are paying more money. When you pay more money, companies have higher expenses, causing the price of things, I'm going to put this as a T, the price of things to go up. Now the price of things go up and people need more money to buy things, so now they go and tell the company, hey, I need more money because the price of things go up. Now the company tries to pay more money and then they have to raise the price of the products, causing the price of things to go up even more, and it starts to create this inflationary cycle. Now, the reason why we were facing this inflationary spiral to begin with has to do still with the 2020 and 2021 pandemic, where we had printed trillions and trillions of dollars. We had printed an insane amount of money, and we just gave this money out to people, to businesses, to the government, and trillions of dollars were injected into the economy while nothing was being produced. So this created supply chain backlogs, right? People had money, they bought things, causing the price of things to go up, making people need more money. They started to create this inflationary spiral, and then people started to go back to work and they said, I can't go back to work at the same salary that I had before. I was making more money on unemployment, or the cost of living is so much more, so I need a raise. So people started to make more money, and then this inflationary spiral started. So now what the Fed is saying, well, how about you companies stop hiring people, because if they stop hiring people, then these wages are going to stop going up. Because if companies don't have to keep raising their prices to attract more talent, they're just going to stop their hiring, then wages are not going to continue going up. If wages don't keep going up, then we're going to break the system, because now companies are no longer raising their wages. So now people will just have to deal with this higher prices, which will ultimately force companies to say, well, no one's buying our higher priced products, so we're going to have to reduce the price of their products. This is what the Fed is proposing. They want companies to do these type of hiring freezes to break the inflationary spiral this way, because you can start to see that they're struggling with the interest rate hikes and they're struggling with reducing the size of their balance sheet because they're worried that that's going to hurt the economy. I mean, if they really wanted to slow down inflation, what would you do? You would do the opposite of the things that caused inflation. The things that caused inflation was a bunch of money printing through stimulus, through quantitative easing, and through cutting of interest rates. If you want to get rid of this inflation, you just do the opposite, right? You just raise interest rates, you start doing this monetary tightening, you remove money from the system, and you do less of this increasing of the balance sheet. You decrease the size of the balance sheet. Now, they've started doing some of this. They've started increasing interest rates. They talked about how they want to reduce the size of the balance sheet, but they haven't really started that. And so now they're already starting to see the effects of this just slight fight of inflation, because they've only raised interest rates a couple times. They haven't really started unloading their balance sheet. And they've already started to see the effects of this on the economy. I mean, just take a look around you. The economy is starting to struggle. You're seeing hiring freezes. You're seeing tech companies starting to lay off employees. You're seeing people less interested in buying a home because mortgage rates keep going up. And so now, if we're really facing this issue of stagflation, where you have high inflation and a slowing economy, the Fed can't come out and say that, because if they said that, that would create panic. People would freak out in the markets, they would sell, and you would see a massive stock market crash. So instead, they say, don't worry about it, but instead they come up with weird statements like, stop hiring more people, slow down the hiring, stop raising people's wages, as a way to control inflation. This is where one of the most important things that you can be doing right now is be taking everything that you hear from the Fed and the government with a little grain of salt or a pound of salt, because in one of the recent Fed interviews that I was listening to, somebody asked Jerome Powell, the chairman of the Federal Reserve Bank, how could you get inflation so wrong? How could the Fed, who is made up of some of the highest paid and the smartest Ivy League economists in the world, get inflation so dead wrong? And his answer was pretty straightforward. He said that nobody could have saw it coming. None of these economists saw this type of inflation problem coming. Now, I want to add one little caveat there, because it wasn't that nobody saw this inflation problem coming. I mean, I've been talking about this inflation problem for the last couple of years, and our subscribers all knew this inflation problem was coming. So people who were dealing in the real economy, people who go to the store and buy their groceries, who have to deal with everything going on in the economy, could predict and saw this inflation problem coming. People were feeling the effects of this a year ago. But it was the people that are making the big bucks at the Fed and these high-paid economists who did not see this inflation problem coming. Now, the reason why I bring this up is because when most people work a job and you do something so wrong, you do the worst performance that the company has ever seen, well, then typically what happens is you lose your position, or you lose your current title, or something happens, something disciplinary, that way you can be better at your position. But in this case, it works a little bit different, because after the Fed got inflation so wrong, it was known as the worst mistake by the Federal Reserve Bank ever, Jerome Powell was nominated by the presidential administration for another term, and then he was confirmed by the Senate for another term as the chairman of the Federal Reserve Bank. This is why I want you to be a little bit cautious with everything you hear, because sometimes the Fed and the government say things to keep people calm when they know that things are a big problem, because they don't want to create panic. They're trying to solve the problem behind the scenes without people worrying about it. And what you want to do is not be reactionary, but instead be proactive and start planning what you're doing with your money today. Start planning how you're going to be smarter. That way you can take better action and take better care of yourself. Because even Jerome Powell has come out and said to himself that this fight against inflation is going to be painful. Now, painful doesn't mean that he's going to get punched in the gut. Painful means that people are going to lose their money. People are going to lose their jobs. People are going to see their investment portfolio get hurt. And this is where you have to be smart and understand how can you come out of this in the best position possible financially. I think a lot of people have a general understanding of what stagflation is, but let me dive a little bit deeper, because stagflation actually involves three different things. It involves the GDP, which is the economy, the growth of the economy. It involves unemployment, I'll put that unump, and then you have inflation. So when you have stagflation, like we saw happen in the 1970s, you have very high inflation and potentially growing inflation. You have a slowing GDP, meaning you have a recession, an economy that's getting smaller, and then you have high unemployment. Now, it's kind of a weird concept, because you have prices of things that are very high, yet you have an economy that's shrinking, and then you have people that don't have their jobs. So it's kind of like the worst case scenario, which is why everybody was so worried about that in 2021, and they're still saying that it's not something that you have to worry about. But with everything that they've been wrong about with inflation, this is something that you should consider and just keep in the back of your mind, because if you have the price of things very high and you have a lot of layoffs and you have a slowing economy, this means that companies aren't hiring the way that they were before. Meaning if you lose your job, it's going to be tougher for you to find a new job. So you have an economy that's shrinking, you have a lot of people without jobs, and you have an expensive cost of living. The best way for you to prepare for this is really just to prepare. That means prepare financially. Now, of course, if you're looking for an easy way to stay on top of what's happening in the finance and business world, you can just subscribe to Market Briefs. It's a free financial newsletter that I created. In Market Briefs, every day, my team is working to break down what's happening in the top finance and business news into a fun, witty, and easy to read email. You can read this email in less than 5 minutes every morning. That way you don't have to spend all of your day going through every single different news site. It's fun to read, it's simple, and you're going to look forward to reading this email every morning. So if you want to subscribe to Market Briefs, it's completely free, and you can do that by clicking the link down in the description below. The second thing that you might want to consider doing right now is cutting back. Now, I know this can be a very difficult thing to do right now, especially when the prices of everything is so high. But this is really the time where you want to be able to have a little bit of cushion in your finances, because we don't really know exactly what's going to happen in the next 3 months or the next 6 months or the next year. So if you can, try to cut back as much as you can on some of your expenses. Maybe cancel some of your subscriptions, maybe don't eat out as much, and maybe don't spend so much money on luxuries and designer items. Just save that money right now, put that money into an emergency fund, and have it aside just in case anything happens. I mean, if nothing happens to you, your job, or your company, well, this is some extra cash that you can use to just keep investing your money. I would also highly use this time right now to stay away from credit card debt, payday loans, and any sort of buy now, pay later, because right now we're on an interest rate growing environment, which means that all of these loans, which are variable interest rate loans, the interest rate on your loans are going up because the Fed is working to raise interest rates. Now, we've talked about this before. The Fed is raising interest rates to fight inflation. And so when the Fed raises interest rates, your credit card interest rate goes up. And so when all of these variable interest rates go up, your monthly payments start to go up. So you do not want to be racking up a credit card balance now, because a credit card balance today is going to be more expensive in 2 months and 3 months, because as interest rates go up, your monthly payments go up because the balance just gets more expensive. So if you already have credit card debt, you want to be even more aggressive to pay it down now while interest rates are lower rather than in the future, because if the Fed raises interest rates again in a month and 2 months, well, that means it's going to be even more expensive to pay it off in the future than it will be now. And the last thing that I want to mention has to do with investing your money, because when we go through these types of turbulent times in the economy, in the market, this is where you start to see a lot of panic and a lot of fear. Now, back in 2020, we saw a very unique V-shaped recovery in the stock market, where the stock market crashed very hard and then it bounced back up very quickly. I do not expect that to happen again. So what you want to be aware of is understanding how investments work, how asset classes work, and understand that if you really want to make money in any asset class, it's going to be patience that's required. That means if you see buying opportunities, buy them, because when you see a market crash, when you see a recession, that's when asset prices go on sale. You just want to make sure that you're doing your research and you're investing your money into a good investment so you can buy them when they're cheaper, but don't just expect it to turn around in 2 weeks. Don't expect it to just double your money in a month. Invest with a long-term mindset. Don't just be a trader, because the majority of traders will lose their money. Now, sure, traders can make a lot of money, especially when markets are going up or when they're very volatile, but the people who make the most money over the long term are not traders, they are investors. So look for good opportunities, and when you find them, you can buy them, buy it on the way down instead of trying to perfectly time the market, and then be patient and hold. Because now not only do you have to hold the stock, but you also have to hold your patience, because when you see the markets get hit very hard, people will panic. They'll talk about the world ending. They'll talk about the stock market ending. They'll talk about everything just completely going down. And it can make it very hard for somebody to invest. It can make it very hard for somebody to hold. But this is where you want to have the patience and the financial discipline to just tune things out. Because when you make your investments, then just hold on to it. The only thing you should be aware of is this company going to go bankrupt? Can it ride out the recession? Can it ride out whatever's going on? So that's the thing that you want to be paying attention to. And then when you see discounts, that's an opportunity for you to come in and buy. If you enjoyed this video and you want to see why the housing market is on the verge of doing some crazy stuff, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. These banks that are making loans are seeing mortgage applications drop because interest rates are going up. And so to combat this higher cost of getting a mortgage, they're now selling these people ARMs, adjustable rate mortgages,